is the 12th chapter, capital structure and finance cost. Okay, so I'm just going to summarize. So business needs funds in order to survive, right? And that fund comes from two sources. One is by taking debt and the other is through capital. Okay, capital we say equity, right? And what we do is share capital can be a big amount. Okay, let's just say it is 100,000 for now. Okay, just for reference I'm saying 100,000. These share capital could be divided into smaller units and these smaller units are called shares. Clear? And they would actually take one share for, let's just say, $1. Then this becomes the nominal value or the face value or par value. Understood? But it is different from what the market actually perceives those shares. So for example, the market might make it a $3 per share. Clear, no? So in such case, this is the market value. Just a moment. So in such case, this is the market value, okay, and this is the par value. Understood, no? Same way also, we have something, a debt called as a loan note. Understood? And loan note, again, same concept. There could be a big amount, okay, and by default, the par value or the nominal value is always 100. Understood? Unless mentioned in the question, otherwise it is always 100. Clear? So in this case, this is the par value and this is the nominal value. Clear, no? Okay. Now we are going to take more, go more in detail. Okay. So equity shares are of two types. Okay. One is ordinary shares. Okay. And the other is preference shares. Clear? So ordinary shares are the true owners of the company. Clear? That means they have the voting rights. They can make the whole decision. Okay, but the dividend is upon the profitability of the company. Clear, no? Whereas preference shares get a fixed dividend. Okay, and they are not true owners of the company because because they always get the fixed dividend. Okay, so their voting rights is below the ordinary shares people. Clear, no? Now preference shares again is divided into two: redeemable and irredeemable. Clear, no? So redeemable as in they should be repaid. Clear? Sorry, redeemable. Sorry. Okay, so redeemable as in they should be repaid. Clear, no? That means if they want to cancel their shares, then at that time of cancellation, we would have to pay them. Understood? But irredeemable are the owners of the company. That means when they want to cancel shares, we are not paying them back. Clear, no? So since this is repaid, this is of liability in nature. Understood? Hence, it is taken in NCA. Clear, no? Sorry, NCL. Sorry, NCL. Non-current liabilities. Understood? Okay. Now, so we have already discussed what ordinary share capital is. We have discussed loan notes, that is same like shares, right? And we have discussed preference shares, right? Okay. Now next topic, ordinary shares. So in ordinary shares, there are different stages. Understood? So I'm gonna explain the stages. Okay, so suppose Elvira, there are $1,000 shares, 100,000 shares. Okay, and this is called as the authorized capital. Okay, this is the capital by which the company is registered in memorandum of association. Understood? Okay, and these are 10,000 shares of 100 each. Let's just say 10 each. Clear? Okay, 10,000 shares of 10 each. Understood? Together they become $100,000. Understood? If you have 10 chocolates, each chocolate cost you $2. What is the total amount of chocolates that you incur? 2 into 10, $20, right? So that is the same logic here. Clear?
Yeah, 10 shares and each share.
Yeah, 10,000 shares and each share cost you 10 each. Clear? So the company decides out of this they are going to issue only $50,000 shares. Clear?
It's additional, right?
No. Out of the 100,000, they decided that only 50,000 would be collected. Understood?
Okay.
So they gave the public only 5,000 shares of 10 each. Clear? Understood? No? So this share is called as issued capital. That is for issue for the public. Understood? Okay. Now the third situation is the public. It is not necessary that the public would take those in full, right? So what the public does is out of the 50,000, public took only 40,000. Understood? That is 4,000 at 10 each. Understood? So in this case, it is called as subscribed capital. Understood? Clear, no? Now, again there is a division. So people subscribe to 40,000, but they may only pay 20,000, for example. Clear? Okay? And this is called as subscribed and not fully paid up, because they have paid only for 2,000 at 10 each. Understood? This is subscribed and not fully paid up. Understood? Just for know-how, it is just for OTQs. Clear, no? If they have paid in full, then they are called subscribed and paid up. Understood? Clear, no?
Yes.
Okay, clear? Now, so those ones which are not issued is called as unissued capital. Clear? So the remaining 50,000 becomes unissued. Clear? Now those capital which is not subscribed is called as unsubscribed capital. Clear, no? So among the 50,000, 40,000 is subscribed and 10,000 is unsubscribed. Clear? Understood, no?
Yeah.
I'll send this. Okay.
Thank you.
Clear? So that is what all you need to know. Next is the accounting treatments. So when you issue shares, you get cash at bank, right? So it is debited. Clear? And you're getting capital, so capital is credited. Group 2 in nature. Clear? And
you remember here I was like asking you like if share capital on memorandum, but
yes,
it's not paid, how?
Yes. That is paid out of reserves, right?
Like how I just record like automatically unpaid shares, but on current asset.
Okay. Next is accounting for issue of shares. We have discussed cash at bank, or bank is group 1 in category, so you're going to debit it, and share capital, when it increases, you're going to credit it. Okay. Now you must understand a very important thing. Share capital is always the nominal value into number of shares. Nominal or par value, or we say face value. Clear, no? For share capital, it is always that. So if your market value is 12, but your shares nominal value or par value is 10, then you are on the share capital section, you are only going to take 10. Understood? Even if you receive 12, you would only take 10. The extra...
I will look always only on memorandum and what is there is written, I will take that, right?
Yeah. And if you get anything extra, that is called a premium. So here the 2 is called as share premium. Understood? Okay, that is the difference between the issue price and the nominal value. Clear, no? Okay, so you're going to debit bank, okay, and credit share capital, credit share premium, because it is group 2 in category because of its income nature. Understood?
What documents I need to have for this record the share premium?
No such documents. You just need the proof of whatever you have received, right? You have received. Okay, we'll do with this an example. Bourbon Company issued 200,000 shares, right? So 200,000 shares were issued, 25 cents share at a price of 1.75. So this is how you record it. Debit bank, and for bank, how much do you get? Census fills. Clear? Census fills. So if it wants to be converted, how do you convert? Divided by 100. Clear, no? So this here is 1.75 because you are selling it for that much, and you're going to credit share capital, and for share capital you are getting 200,000 into what is the nominal value? 0.25. Clear? Because it is sold for 0.25 only. See, 200,000 of 25 cents shares, but it was priced at 1.75. Understood, no? And I have already told you, for share capital you are just going to take the nominal value. That's it. Clear?
Second, what is this? Credit as is abbreviation. Second one.
Second one?
Record. Credit.
Yeah, second one is share premium, credit share premium. And the remaining 1.5 would be taken into that account. Clear, no? Understood? Okay.
Okay.
I'll send this to you. You can do it after class. Is that fine? That way we can complete the chapters. I'll send this to you. You can ask me doubts when you do it, okay? If you have any doubts, you can ask me. Okay, next one is rights issue. Okay, so there are different types of way or methods by which you actually issue shares. Okay, so the first one is rights issue. Clear? Okay, rights issue simply means that instead of giving the shares to the public, you're going to give it to existing shareholders. Understood? We are talking about big companies, registered companies. So registered companies actually give their shares to the public, right? So all it is saying here is, instead of giving those shares to the public, you're going to give it to the people who have already been the shareholder of the company. Understood? Okay, so the advantage is, it is the cheapest way because you don't need any advertisement. You don't need any brokerage fees. Clear? Second one, it could be given to the current shareholders and you are sure that fully it would be subscribed and paid. Understood, no? But there are certain disadvantages. The disadvantage is that the rights issue is going to be very expensive, okay? Because shareholders need more returns than we take debt, okay? For example, shareholders expects maybe 20% return, but when you take a loan, it is only a 6% interest. Understood? Clear? So often the cost is very high. Understood? Now the second disadvantage is that it is not successful if you want more and more finance, because people are not going to take it up. Understood? Okay, let's see. So there is just one single rule for rights issue. So listen to me carefully. Elvira, recordings of this class would be provided. If you have doubts, you can go back and see. Okay?
Okay.
Clear? So the shares here, let's say, upon incorporation in 2004, JBU Company, a limited liability company, issued 1,000. These information are not that important, all right? So they issued 1,050 cents shares. That means the par value is 50 cents. Clear, no? Okay, and they need more funds, right? So they made a rights issue. Okay, and remember, when it comes to rights issue, the fraction is important. So fraction is here is 1 for 5 shares. So you're going to take it as 1 by 5. Clear? And they have issued it for 0.75, which is greater than the 0.5 cents. Then that means there is a share premium. And this is how you record it. I'll write it here. So first of all, you have given shares, debit bank, credit share capital. Clear? First issue, that is 1000 into 0.5. Clear? Then the second time, what did you do? You took a rights issue, right? So again, debit bank, credit share capital, and credit share premium, because it was given for more than the par value. Clear? So in the bank, what do you do? What is the existing shares? 1000, right? And then you're going to take up the fraction, that is 1000 into 1 by 5. Clear, no? 1 for 5 means 1 by 5. 2 for 5 means 2 by 5. 1 for 10 means 1 by 10. Understood? So every time there would be a fraction given to you. Clear? Okay. So you're going to take 1 by 5 into how much did you get? 0.75. Okay. And here again, 1000 into 1 by 5 into 0.5. That is the par value. Here the remaining 0.25. Clear, no? Or what you can do is, you can just subtract this and this and take the value in share premium. Understood? Clear, no? I'll send this to you. Got it? Got it, no? Hello?
Yes.
Got it?
Just a second. Yeah, got it.
Okay. Next is bonus issue. Okay. So bonus issue is when, okay, you're going to sell the shares to the shareholders itself, but the difference is you're not getting cash from it. This is what I told you. Clear? This is your doubt currently, right? What do I do if I don't receive the amount? Clear? So if you're not going to get cash for issuing your shares, then that becomes bonus issue. Understood? Okay. So the advantage is that you can actually divide your share capital again without the payment of money. Clear? Okay. And share capital could be, that means if you have too much share premium with you, we have already told you, right? Share premium is something that you get extra out of the share capital you raise, right? So if you have too much share premium, you can just use that extra share premium to give extra shares to the existing shareholders. Clear, no? The disadvantage is, even if it is for free, there is administration cost, because there is someone who is going to record it, who is going to spend their time on it, right? For example, you. Clear? Okay. So what is the entry? You can either take it from a share premium or any other reserve you have with your company. Clear? So that is going to be debited because it is going to be decreased. Income when decreases, you are going to debit it. So it can be share premium, it can be retained earnings. Okay? So it can be any income that is already there in the company. Understood, no? And since share capital is increasing, you are going to credit it. Okay? Clear? Now let's see this question. TYU 3. GKL company currently has 20,050 cents share in issue, right? Each issued for 1.25 dollar. Okay, so you must understand there is 20,000 shares. The par value is 50 cents, right? And the share in issue is for 1.25. That means the extra 0.75 is there. Is it 0.75 though? If it is 0.75, it is that their premium is 0.75. Clear? 1.25 minus 0.5 would be 0.75. Yes. So here 0.75 cents extra. Sorry, $0.75 is premium. Clear? No, Elvira?
Just a second.
They
50 cent, it is the price of shares.
yes,
and,
$0.5.
Okay, and
They sold it for 1.25. So that means
1.5 they issued, so the difference will be premium.
yeah,
Like that, right?
exactly. Clear?
Plus 75 is 120.
Yeah. So the problem is they did a bonus issue now, right? And the bonus issue they did for 1/4. Clear? 1/4. Understood? So keep it there. Now you can do it two ways. Either you can do it by creating each journal entry. That is a big process. So I don't encourage that. So instead of that, we are going to make two columns. One column for share capital and the other columns for share premium. Clear, no? Okay. And then you're going to make it as a first issue. So first issue, what happened? You gave the share capital for how much dollars? 20,000 into
50.
50, 0.5. 50 cents is 0.5. Clear? So that means here it is 10,000, right? And here it is 20,000 into 0.75, that is 15,000. Clear, no? Second time what happened? There is a bonus, right? And how much is the bonus? 20,000 shares into 1/4. Understood? 20,000 into share into 1/4 is, sorry, 20,000 into 1/4. 5,000 shares. Clear? Clear, no? So here, but the problem is, in this case, you are taking that away from share premium. And for bonus issue, always the amount would be the nominal value, 0.5. Clear, no? So 5,000 into 0.5 would be 2,500. That is taken away from share premium and added to share capital. Clear, no? Clear? So how much is the net amount? Here 12,500. Here it is 15,000 minus 2,500, that is 12,500. Clear, no? Understood? Clear, Elvira? Clear, Elvira?
Yes, somehow.
I'll explain it again. Okay, I'll take it from the top. So 20,000 shares was there, right? And the nominal value was 50 cents, that is $0.5, but they have issued it for 1.25. Hence we get a premium of 0.75, right? So here we have taken into 0.5. Here we have taken into 0.175, right? So together we get 1.25, right? Clear? So the balance on the first issue is this much and this much, right? And then 5,000 into 1/4, we have got 2,500. That is from bonus issue. But bonus is taken from share premium. So we have deducted under share premium. Understood? So 12,500.
From already existing one, right?
Yes. So the answer is 12,500. Clear? Okay. You can rewatch the recordings, alright? So when
You will send this part?
yeah, I'll send the recordings today itself. Okay. Just after the class, you can sit and write the questions. Okay. Okay. So this TYU 4 would be homework. Okay, no? Next is dividends. So see, as I've told you earlier, shareholders don't do things for free, right? So they expect something in return. Okay? And that something is called as dividends. Understood? Okay? For example, they may have an intention that they should get 20% of what they invest. Understood? Okay, so the company needs to pay dividends to the shareholders, right? So you're going to debit retained earnings because retained earnings is an income account and you're going to take dividends from retained earnings. Understood? Clear? So when the income reduces, you're going to debit it. Understood? No? And you're paying out cash to them, right? So credit bank. So credit bank. Understood? Okay. Now I'm going to teach you an equation. That equation is closing retained earnings is equal to opening retained earnings plus P&L for the year, that is the SOPL, profit for the year, minus dividend paid. Clear, no? This is the equation. So if your question has given you all of these details but this is missing, you know how to calculate it, right? If the question has every detail but this is missing, just interchange the equation and find the dividend. Understood? Clear, no? Now, so the shareholders are the people who are going to discuss about or decide with the management on what dividend is necessary. Clear? And it is done through a meeting called as annual general meeting. Understood? Clear, no? It is in short form, it is known as AGM. Okay? And until that time, there is literally no need for the management to pay the shareholders the money. Clear? Okay? And remember, there are two types of dividend. This is not in your syllabus, just to know how. Okay? The first one is declared dividend. Okay? Declared dividend. This is a liability. Understood? Because it is already decided. Okay? The other is proposed dividend. That is in plan, which is not yet finalized. Clear? Hence, this is just a disclosure note that you give. Understood? No liability. Understood? No? Clear?
Yes.
Okay. Yeah.
This dividend can be paid only
End of the financial year. Yes. After everything. After you calculate profit for the year only, and after the general meeting is the point at which you pay the dividend. Clear?
But there is not such a term, kind of interim dividend, like when they.
Yes. There is interim dividend when there is a need to motivate shareholders. What you do is you pay dividend from the middle of the accounting year in order to motivate the shareholders, but not necessarily something that is done by all the companies, but just in case. Clear? That is something that you study.
A lot of profit and.
Yeah, exactly. Yeah, exactly. And also, there is a theory. When you reach the higher levels, you will study. That is more the dividend, more the share price. Clear? So, in order to boost the share price, companies often use these strategies. Clear? Okay, no? Now, the next topic I've already discussed. When you're going to split That is when you want to get money, or when you want to have to raise finance, what you do is you borrow things from the public, right? And let's just say you have an amount of 100,000 to be borrowed from the public. Then you're going to divide it into small units, and small units are called as loan notes. Clear? Okay, unless it is specifically mentioned always and always, it is $100. Clear? No, that is for one loan note. Understood? So if it is 100,000 loan notes, how much loan note would be there? 100,000 divided by 100, that is 1,000 loan notes would be there. Clear? Understood? No? Now the accounting entry is simple. You're going to get cash, so you're going to debit bank, right? And on the credit side there would be liability recorded, that is NCL. Understood? Okay. Now loan notes don't come for free. It is just like a borrowing. Clear? Long term borrowing. Understood? So you have to
Close the door.
Hello? So you okay. So loan note don't come for free, and hence you have to pay interest upon it, and that interest is called as finance cost or finance charge. Clear? Okay, so you're going to debit finance charge, okay, and you are paying the finance charge either by cash or it is going to be a payables. Understood? So you're going to credit it. Okay, clear? No?
This loan interest can be added same account for loan, and it can increase loan amount, or
yes. So this is something that you study in the next level. Okay, so either you can take on the same account if you are not going to pay anytime sooner, but if you are going to pay it in 1 year, you have to open a current liability. Clear? So it depends. So in the next, see, that is what they have mentioned here. Rest of the others you would learn in ACCA studies later in IFRS 9. Clear?
IFRS 9 is about loans.
Yeah, exactly. Not just loans, all the other things also related with all the financial instruments. That is a very long topic that you study in FR, SBR, and AAA.
It is the next level of ACCA.
Yeah, exactly. Okay, so let's continue. Now, Custard Creameries Company needs to raise funds to purchase plant and machinery. Clear? So on 1st March 2005, they issued 150,000 10% loan notes. So I have told you, when there is something of a percentage given, then that is the interest that they are expecting, the returns they are expecting. Okay. So on the 150,000 loan, you have to pay 10% interest. Okay. And it is redeemable in 10 years time. Clear? No? That means you have to pay it back only after 10 years. So that is a non-current liability. But the problem is, they don't come for free. You have to pay interest. Okay. And instead of paying it as a yearly interest, they are asking you to pay half yearly. Okay, that is on August you have to pay an interest, and for the next year you have to pay an interest. Clear? No? So tell me, the accounting year stops at 31st December. Okay? So from after August you can only take interest till 31st December only. Clear? And this makes it a payables. Clear? Understood? No? So what you do is, first you are going to record the taking of the loan, right? So the bank credit non-current liability, or credit, the name is 10% loan notes. Clear? How much is it? 150,000. This much is okay? Clear? No? So this is the thing. But on August you have to pay interest. Clear? So debit finance charge. How much? from January till August. How much is it? 150,000 into 10% into January, February, March, April, May, June, July, August into 8 by 12. Clear? Understood? No? You're going to pay it by bank. This much is okay? And let's just calculate the value. It would be more good. Into 0.1 into 8 by 12. Right? So that is 10,000. Clear? 10,000. Clear, no?
Yes.
And after that, your ending is on December, right? So on December, you're going to pay again finance cost. Right? But this time, how much do you pay? 150,000 into 10% into after August. That is September, October, November, December into 4 by 12. Clear? Understood? Until only December you are going to pay. Clear? Oh, sorry. This one, you don't start from January actually. What is the point of interest? I'll show a map, okay? So your year beginning is on 1st Jan, right? Your end is on 31st December. You can see the screen, right?
Yeah.
Okay. The problem is you're going to pay the loan interest at February here, and you're going to pay interest at August here.
2 months, right? January, February.
Yeah.
First.
February and August, was it? Okay.
Can you close the door?
You're paying it on February and August, right?
It's 2025, right? Currently.
Yeah. So February
So-
till August, one type of interest, and August till January, another set of interest. Clear? That is the cycle.
see.
Understood? So what happens is that this year starts from January, but there is no interest that you pay on January. So you start from February, March, April, May, June, July, August. 7 months. Clear?
From first one start from February or from
February,
January?
not January, because loan is payable on August and February, right? So this year it starts from February. Understood? So February, March, April, May, June, July till August, it is 7 by 12. Clear, no? Understood? And what about here? Here it is the same. From August, September, October, November, December. 4 by 12. Clear? But do we pay? Is it credit bank? No. It is credit payables. Understood? Okay. Now in the SOPL, what happens? In the SOPL, you're going to take the finance cost of two things. February plus until December. Clear? That is, these two should be taken together. Understood? In the SOF,
but here, like on 1st March, issued loan notes. It means like they got loan not on February, only from March 2005.
oh yeah, exactly. So that is my mistake. So it was taken from March, right? So again, thank you. So how much is it? March, April, May, June, July, August. 6 months.
Okay, 6 months.
Okay, great, Elvira, good. Okay, so from March till February, August. But from the next year, you are going to take it from February. Clear? Okay. So you have taken 4 months here, 6 months here. So both of these interests should be added together and shown in the current year. Clear? In the SOFP, you have got non-current liability of 150,000, clear? And current liability of this year's interest, clear, no? Understood? Payables.
Yes. Yeah.
Okay, I'll send this.
Yeah.
I'll compile the recordings are in pieces, so I'll be compiling the recordings and send it to you within 2 hours or so. Clear?
Thank you.
Okay, that way you.
Because I have like every company has like loan agreements, and I already practiced before that recording this loans. Little.
Yeah, loan notes are
When
different.
I practice, I have little like understanding, but which things I don't have on my practice,
Okay.
I'm suffer on the
No
topics.
problem. Then we'll do it like this. We'll move on with the topics and send you the recordings as soon as the class is over. Clear?
Yeah. Yeah.
Okay.
Thank you.
Next is the preference shares. Okay, preference share I've already told you there are two types. One should be payable, repayable, and the other is not repayable. Clear? Okay. So one which is payable is called as the non-current liability. So it is taken under non-current liability itself, even if it is a share capital. Clear? Understood? Okay.
Redeemable, it is mean like what? Redeemable.
Redeemable is repayable. So it is just like a loan. Okay, it's like a loan. Like a loan. Clear, no? This one is the same thing. The only difference is that the name of the share capital is changed. From ordinary share capital, it is changed into preference share capital. Clear? Okay? And here we have an interim dividend. See, the part way through you have to pay 12 cents per share. Okay? To its ordinary shareholders and paid the dividend due to the preference shareholders. So what you do is 2 columns, right? One is for SOCIE, that means what happens with equity, and one is for SOFP. Clear? So here what you do is, in the beginning you're going to issue shares, debit. That is 2 types of shares are there, right? They have given you ordinary share capital balance and also irredeemable preference share capital balance. Both shares are different. Okay, so ordinary shares, preference shares. Clear? Okay, one is 200,000, the other is 50,000. Clear, no? And what happened? They have declared a dividend, right? That is 12 cents per share to equity shareholders. Understood, no? So here you need to understand how many shares is there, right? So how do you calculate number of shares? Number of shares is equal to amount of 200,000 divided by per share value, that is 0.5. Clear? If you have got a chocolate for $100,000, okay, and each chocolate cost you $10, how do you calculate for how many chocolates you got?
1,000 divided by 10.
So same logic here. Clear? So in order to calculate number of shares, what do? You're going to divide. Understood? Clear, no? So 200,000 divided by 0.5 is 400,000 shares. Clear? Into how much do you pay for one share? Dividend is 1.25. Understood? That is 12.5 divided by 100. How much is it? 0.125. Sorry. $0.125. They have told you 12 point per share, right? So that in dollars is how much? 0.125 shares. Clear? So 400,000 shares gets a dividend of 0.125, a returns of 50,000. Understood? Clear, no? And paid the dividend due on preference shares. So preference share dividend is calculated as 8%. Understood? So that is equal to 50,000 into 8%. That's all. Clear? Understood, no? So 50,000 into 0.08 would be 4,000 for preference shareholders. Clear? Understood, no?
Yeah, I will just review.
Okay? That is T by U 6 listing. Here. So we have got number of shares. That is what we got, yeah? We have got interim dividend paid 550,000, yeah? That is what we got. Preference dividend we have got 4,000. Clear, no? Okay? So we don't know how much the retained earnings is for the balance. Okay? But we are going to pay off 54,000 in the current year as dividends. Understood? Clear, no? So that is all you need. So from the SOIE, you're going to take 54,000 off. Okay?
What is an SOIE? A
Statement of changes in equity. SOCE.
SOCE.
We studied, right? On the formats.
Yeah, statement of
Changes in equity. Yes. Okay, next is apart from all these reserves, we have got something called other reserves, which is used for storing some other things or income that the company earns. This is not that important. Clear? Okay.
Reserve is like kind of.
Yeah. And there is also revaluation surplus. We have already studied that. And retained earnings is the accumulation of all the net profit throughout the years. Clear? Understood, no? Next is income tax. Okay. So listen carefully. So we have to pay tax when we generate income, right? So for the company, for a sole trader, it is an income tax, and partners also it is an income tax, right? But for company, it is income tax, but we have a different name for it. What was that?
Corporate tax?
Yes, it is here somewhere. Can you see? It is here somewhere in the middle. Corporate tax. Where is it? Where is it? It's here somewhere. Okay, anyway, it is the same as corporation tax. Clear? This is the corporate tax. So the income tax paid by the company is called as corporate tax. Clear, no? Okay? And the problem is we can't actually estimate, or we can't wait until the profits are earned in order to pay taxes, right? So what you do is you're going to beforehand calculate some money. Understood? Okay, and that is why it is called as a tax estimate. Understood? Clear? And we need to make the best estimate for tax. Understood? Okay, and we take all this tax under an account called as provision for income tax. Understood? Okay, just like you calculate depreciation, you calculate tax and keep it in a tax account. Clear, no? That is provision for tax. So your first duty is to calculate what tax would be there current year. Understood?
When I need to start to do this one, like.
See, this is actually done. That is when you do the accounting year. The problem is that accounting uses accrual concept, right? Okay, but tax uses cash concept. Understood? That means tax is only paid or is chargeable on the cash that you pay or receive. Understood? But the problem is, for accounting, every year when you finish off an FS, that is when you finish off a balance sheet, you pay tax over those results, right?
Yeah.
Okay, but you calculate it, but you don't pay at that time, right?
Yeah.
Okay, so that is called as a provision, because you're calculating but you're not paying. You're only paying when it is due, that is when the cash is finally in and out, or during that date of specific date at which a country needs to pay taxes, right? People need to pay taxes. Clear, no? So at that time you make certain adjustments over the tax expenses that you have calculated from the accounting entries. So in that much deep knowledge you would do only in the next level. Clear? In this level you just need to know that these taxes are taken in income tax liability account. Clear, no? Okay? And always when you estimate taxes upon the accounting concept and the tax is actually due according to the tax authority, there would be a difference. Clear? And that difference is called as under or over provision. Clear, no? Understood? Under or over provision it is called. Clear? And when you pay income tax, what happens? You're going to debit the tax liability because it is no more, and you pay cash, so it is credited. Okay. Understood, no? Now, at the time of payment, you would know whether or not what you have calculated is wrong. Okay, whether it is more, whether it is less. Clear? So in that case, two things happen. Either it is under provision or it is an over provision. Understood? I'll mention what it is. This much is clear? Okay. Listen to me carefully. So last year, that is in this accounting year, okay, 2024, December, when the SOPL was ready, I estimated that the tax is going to be 5,000. Clear? And this year, during February, suppose during April, okay, during April, I have to pay taxes, right? So at that time, the tax authorities recalculated my calculations and they told me that I have to pay 6,000 this year. That is in relation to last year. Clear? So remember what I did? I only took 5,000, right? So this is called as under provisioned because I have calculated much less tax under. Clear? Understood, no? So in this case I have to pay additional tax, right? So I have to adjust it. So this year what I do is I am going to take debit income tax again and I am going to adjust that 1,000 again into the tax liability. Clear, no? Understood?
Just add additional.
Yeah, additional tax. This is like an expense. So it is an expense. You're going to debit income tax and you're going to credit the tax liability because it is increasing. That is group 2 in nature. Clear, no? Understood?
Yes.
Okay. Now listen to me carefully. I am going to erase this off and I am going to take the second situation. So I have calculated 5,000, right? But when the tax authority calculated, it is just 4,000. Understood? Clear?
Yeah.
Now this would mean that whatever I have calculated is actually very much more than what the tax authority has actually given me, right? Okay, that is what I should actually pay. So that means I have overly taken the amount last year, that right? So that is called as over provision. Understood? So in this case, what I have to do, I have to bring down the tax liability account, that is tax provision account. Clear? So I am going to debit it. Clear? And I have to bring down my expenses as well, that is income tax. So I am going to take it down. So I am going to credit it by 1,000 this year. Clear? Understood, no? So summing it up again, under provision is when you pay less or you show less than what was actually paid. That is under provision. When you have showed more than what you actually pay, that is over provision. Clear, no? Okay, and this is the format to calculate the value. You're going to take the current tax estimate. You're going to add under provision, okay, and deduct over provision, and then you reach this year's tax. That is tax for SOPL. Clear, no? This is SOFP. This is SOFP tax, the tax that you show in SOFP. Clear, no? And this is also taken in SOPL. Understood? So when you re-watch the recording, make sure you copy this format down. I'll be sending you a PDF with this format. Clear?
Okay.
That is here somewhere. I'll send you something, but you need to study only the this one here. Okay, this is here. I'll send you this. Okay.
Thank you.
Okay. So in this case, let's see. See, in the exam, you can select what you want. If you want to do it ledger wise, you can always take it ledger wise, taking the journal entries and stuffs. Clear?
Sorry again.
If you want in the question, you can take it ledger wise or just do a simple calculation. Clear?
Okay.
So here they have asked you to prepare tax account for 2004 and 2005, right? What happens in SOFP and SOPL, right? So GB commenced trade on 1st January 2005. Just a moment. You can see the screen, right? Can you see the screen?
Yes.
Okay, here. You can see the screen, right?
Mm-hmm.
Okay. Income tax. So what we do here is, okay, so they have told us to calculate for 2004, okay, and they have told us for 2005 as well, right? Okay, see what happened. The trade was commenced on 1st January 2004, clear?
Mm-hmm.
And they have already estimated the tax to be 150,000 last year, clear?
Mm-hmm.
So last year, according to the format, tax estimate is how much?
150.
150,000. Is there any under or over provision in the question? No, right? So add under provision and you're going to deduct over provision. Clear? Add under provision, deduct over provision. Clear, no? And both are nil. Okay, hence the tax expenses during the year is how much? 150,000 itself. Clear, no?
Mm-hmm.
So this goes to SOFP. This goes to SOPL. Clear?
Mm-hmm.
Understood? This much is okay?
Mm-hmm.
Okay. Now, in 2005, what happened? Okay. In 2005,
13,000 was added, right?
received and paid a tax of 163,000, right?
Mm-hmm.
So, how much was paid?
163.
One, sorry,
63.
163,000. Clear?
Mm-hmm.
Okay, no? At 31st December, it was estimated that the amount would be 165,000 for income tax in relation to the year ended 31st December 2005. Okay?
Mm-hmm.
Mm. So the tax expenses or tax estimate can you see? Okay. So the tax estimate that we did before was how much? 150,000, right? So this becomes the opening balance this year.
So
Understood?
it's for which year? 150 was estimated.
This is for 2004. Clear? Okay. But what happened in 2005? What happened? In 2005, the tax estimate that they have told you to take it as how much?
163.
65,000. Here. That is paid, right? This is paid tax. Clear?
Are you showing me something now or not?
Yeah, I'm sharing the screen. Can't you see?
Because I'm seeing on the first old one, but it's not moving.
It's not moving.
Yeah.
Can you see the cursor moving?
No.
Just a minute. Plain again. So in 2004, the tax estimate was 150,000. Clear? Okay. And since there is no other information given, the tax expenses is also same. Because it commenced on trade, commenced a trade. So this is the start of the business. So we have estimated this much as our income tax. Clear? But what happened in 2005, we actually paid them 163,000, which is more, right? But the problem is in the accounts we have just shown 150,000. So we have to show more. So with the tax estimate of current year, which is already given here as 165,000, we are going to add the under provision as well. That is 163 minus what was actually paid minus previous year provision. Clear? So together this year we have to pay 178,000. Clear now? Okay. So test your understanding 8 would also be a homework. Okay, Elvira?
Which one? There's 8.
Yeah.